Calculating the break-even point is a key financial analysis tool used by business owners. Once you know the fixed and variable costs for the product your business produces, or a good approximation of them, you can use that information to calculate your company's break-even point. Small business owners can use the calculation to determine how many product units they need to sell at a given price point to break even. The break-even point. A company's break-even point is the point at which its sales exactly cover its expenses. To compute a company's break-even point in sales volume, you need to know the values of three variables. Fixed costs, costs that are independent of sales volume, such as rent. Variable costs, costs that are dependent on sales volume, such as the cost of manufacturing the product. How to calculate selling price break-even point. In order to calculate your company's break-even point, use the following formula. In other words, the break-even point is equal to the total fixed costs divided by the difference between the unit price and variable costs. Note that in this formula, fixed costs are stated as a total of all overhead for the firm, whereas price and variable costs are stated as per unit costs, the price for each product unit sold. The denominator of the equation, price minus variable costs, is called the contribution margin. After unit variable costs are deducted from the price, whatever is left, the contribution margin, is available to pay the company's fixed costs. An example of finding the break-even point. XYZ Corporation has calculated that it has fixed costs that consist of its lease, depreciation of its assets, executive salaries, and property taxes. Those fixed costs add up to $60,000. Their product is the widget. Their variable costs associated with producing the widget are raw material, factory labor, and sales commissions. Variable costs have been calculated to be 80 cents per unit. The widget is priced at $2 each. Given this information, we can calculate the break-even point for XYZ Corporation's product, the widget, using our formula above. $60,000 divided by $2 to 80 cents equals 50,000 units. What this answer means is that XYZ Corporation has to produce and sell 50,000 widgets in order to cover their total expenses, fixed and variable. At this level of sales, they will make no profit, but will just break even. What happens to the break-even point if sales change? What if your sales change? For example, if the economy is in a recession, your sales might drop. If sales drop, then you may risk not selling enough to meet your break-even point. In the example of XYZ Corporation, you might not sell the 50,000 units necessary to break even. In that case, you would not be able to pay all your expenses. What can you do in this situation? If you look at the break-even formula, you can see that there are two solutions to this problem. You can either raise the price of your product, or you can find ways to cut your costs, both fixed and variable. How cutting costs affects the break-even point. Let's say you find a way to cut the cost of your overhead or fixed costs by reducing your own salary by $10,000. That makes your fixed costs drop from $60,000 to $50,000. Using the same formula and holding all other variables the same, the break-even point would be $50,000 divided by $2 to 80 cents equals 41,666 units. Predictably, cutting your fixed costs drops your break-even point. If you reduce your variable costs by cutting your costs of goods sold to 60 cents per unit, on the other hand, then your break-even point, holding other variables the same, becomes $60,000 divided by 2 to $0. 60 equals 42,857 units. From this analysis, you can see that if you can reduce the cost variables, you can lower your break-even point without having to raise your fixed costs, variable costs, price, and volume. As the owner of a small business, you can see that any decision you make about pricing your product, the costs you incur in your business, and sales volume are interrelated. Calculating the break-even point is just one component of cost-volume profit analysis, but it's often an essential first step in establishing a sales price point that ensures a profit.